Hello. Thank you so much, and thank you to the fellow panelists for taking time out. Looking forward to this conversation. We're going to talk a little bit about, we started talking about the middle market trap or the growth trap. We actually in India like to think of growth as an opportunity rather than a trap. So let's uncover this a little bit. I'll start with maybe ladies first and, start from you, Shivani. Do you mind talking a little bit about the growth equity opportunity that we've been talking about? Just start with the preamble. Yeah.
The overall growth equity opportunity.
Yes, the growth beyond capital. What are growth equity investors sort of contributing to companies with, and what's the outlook that you have around growth equity?
I think the outlook could not be more exciting, right? In the last 15 years, I think this is the period where finally the rubber is sort of hitting the road. And one of the biggest flips on this and why I am bullish, why you see such buzzing conferences everywhere, is the fact that exits have finally come out of the system, right? So if I look at the Indian private equity market over the last decade, right, $255 billion has exited the market. Out of that, $155 billion has exited only in the last 5 years. So this is a recent phenomena. So how I'm feeling about investing in growth equity now and how others are feeling is great, because you're finally actually seeing that elusive, what we used to call the elusive DPI, right? So it's real now. There are structured ways for us to actually exit investments. There is a very buoyant overall, market, IPO market. There is and it's not just IPO, there's buoyant M&A market. There are secondary deals which are happening. So I think given exits, the overall environment is very, very interesting, I think.
I'll take that forward. I think we are all very excited about growth equity, as an asset class. But what really is the biggest bottleneck to companies sort of growing, and what constitutes this middle market trap? Maybe I'll take that to Dushyant, first. What are you observing? How can we unlock more? Because one of the things that the report talks about is less than 10% of the businesses that can consume growth capital have actually taken growth capital. So clearly something is missing. Talk to us about that. I think there must be a little switch. Yeah, okay.
Hello?
Yeah, take.
Thanks. Look, so I think there are, so when you're talking about the gaps between why only certain proportion of companies actually take up growth capital, I think it's a question of do they all need the external funding? But of those that require external funding, I think it's healthy that not everybody gets funded. Clearly, investors are looking at the potential of those businesses. They're looking at, as an investor, you are looking at not only will the business grow, but will it get to a point where you can exit meaningfully from it. And therefore, not every business actually has the characteristics that make it investable. You are also looking at certain pitfalls. You kind of brought that up as well. You're looking at pitfalls like, does the, will this team be able to, or will this founder be able to build a team below him that can, because all companies at some point, as they grow beyond a point, they need to have a second line of execution and decision making that is capable of taking this to scale. So it's really about unlocking scale, which is about building the team, building the systems and processes, building the culture that can take a business to scale. So it's really about, beyond the potential of the business, can this unlock, certain bottlenecks which otherwise would prevent it from scaling to a point where you could exit?
Yeah. Maybe I'll go to Rajiv quickly on just building on that point. I think the point made is some businesses might not need capital and some are, some have other operational challenges. But is the problem really vision? Because look, if a business is in growth stage, more capital should ideally turbocharge growth and unlock more opportunity. So is it a vision issue or are there operational bottlenecks or other governance-like challenges which prohibit growth capital from getting to, let's say 2x or 3x of what it is?
So, there are two elements to the question you've asked. So on the first side about, whether a business should take capital, external capital or not, I'm in line with what Dushyant mentioned that, there are various aspects. So one, it's a vision issue. There could be some businesses where they feel that, okay, we are happy with the growth that we have. We don't need to get external capital and try to grow faster. Alternatively, there could be an element where someone wants to raise capital because they have the passion, the desire, and the inclination, but the business, metrics might not be the kind that align well with the objectives of, investors who expect a certain type of return over a certain period of time for the business. So that's one element. But on the other side, let's assume that, those elements fall into place. Investors are interested and people take the money and they now need to grow, right? There our experience has been that the biggest challenge comes from the founding team or the CXO level team learning to put systems, processes, policies in place, governance, right? That's critical because a founder can only be involved in micromanaging up to a certain extent. If you really want to scale, you have to think systems. You need to think organization-wide. You need to think, okay, what do I need to do upfront to de-bottleneck? So internally, we have what we call a growth acceleration playbook in which we have 4 elements, right? So one is strategy. How do you think through every element of your business in terms of devising a strategy and implementing it? The second thing that we work on is organization design. Now, this is a very critical element because how you decide to build your organization, find the right people for the right job, right? Make sure that you put a process, delegate actively to them, monitor, supervise, but make sure that things are happening. That's the only way you can grow, right? The third element is, of course, international expansion and governance. Governance is critical. So that's where you put your systems, processes, policies, which tie in with the second aspect, which is organization design. So unless you have that in place, you are definitely going to face the stumbling blocks along the way when you're trying to grow your business.
Yeah. What is, Siddharth, if I can ask you, beyond the team and the governance, do you see Indian entrepreneurs or some of the emerging startups who are scaling up, is there any other challenge that you see, or have they matured? Is it truly just about these two things, or is there more to it?
I would echo what my fellow panelists have said around professionalizing the team and progressing on that evolution of becoming an institution, and that is the journey that takes time. And I think historically, what we have seen, especially in the mid-market space, small, mid-sized businesses have had a challenge in raising capital. There has been historically a supply-demand mismatch in terms of the supply of capital and the demand of capital. And I think that is closing, but we still believe that the mid-market space is quite under-penetrated. Businesses today have to go beyond their founders. And I think the main bottleneck remains the organization being founder-led. The quality and the track record of the founder is obviously critical in terms of determining success. And not just quality in terms of proven execution, but also track record of governance, which we've spoken about. And I think the other important sort of softer factor is their intention and willingness to bring on a partner. And when you look to bring on an investor like a private equity fund, it's a long-term partnership, and it's beyond just capital. So they have to show the intention of having that partner as a thought partner, as someone they're aligned with, and as someone they can work together with to create value together. So I think that also is an evolution. When we look at companies that have never raised capital, there is a bit of an education journey that we we have to take them on in terms of getting them comfortable with having a PE fund on board and what that really entails. So for some more traditional businesses, first-time fundraising also is a bit of a journey that takes time.
Yeah, so I think what you're saying, especially on governance and process, I think companies that are attracting private investments in this nature, they probably lack more. But there is a big flow or a pretty effervescent flow of companies that they have venture funded and they have dealt with professional investors, private investors. Is there a trap where, look, they've gone past the stage of trying to justify the product market fit, but, and there is a need for quest for profitability, etc. But then that has a substantial trade-off to growth. PRS, I'll come to you and, and you've been in the growth space for a long period of time. Over the last 4 or 5 years, how are you seeing this dynamic change? And what used to be, growth to then irrational exuberance and growth, which has now become, let's be cautious. How do you see this playing out and where are we today in that trap, as we are calling it, the mid-market trap?
Look, increasingly we are seeing deal flow of VC-funded companies coming to the mid-market investors.
Yeah.
Previously, we used to see family businesses coming to mid-market investors, and the VC-funded businesses, either they succeed so well that they go directly to SoftBank and Carlyle and people like that, and they don't come to the mid-market. Okay? But that has changed. Okay? Today, we are seeing a lot of deals where companies that were funded by VCs are coming to mid-market investors. I mean, I'm just coming off from listing one of my companies on the National Stock Exchange today morning. And that was a company funded by Nexus. Okay? And Nexus exited and we bought. And we have now taken the company public. Okay? So what I have noticed is that when in those kind of situations, the companies are already founded by professionals. So I'm not really doing any professionalization or corporatization there. Okay? When you have a traditionally family-funded business, then the corporatization challenges come. Okay? So the challenge, the mid-market trap completely depends on what kind of foundation is being laid. So one of the places where we are cautious of is that VCs have funded some hyper-growth business plan. The company has got the DNA of spending to capture market share. And now the VCs don't want to fund that kind of a growth. And the company has to reinvent itself to profitable growth. Not hyper-growth, but high growth. But they have to do it profitably. That transition, a lot of them struggle. Some of them don't make it. Okay? And when we are looking at those kind of situations, that is when the trap is very tricky. Can these guys successfully transition into a new business model? Okay? And if actually a VC funds them to do the transition and then brings it to us, life is far easier for us. Okay? But rather than us doing it. Okay? But I think that is the biggest change I'm seeing. I've been investing for 3 decades. And I'm much more excited today than I ever was in my career. Is because the quality of the entrepreneurs I'm seeing, where we are Series B, Series C investors, somebody else has laid the foundation, okay? And we are then truly scale-up investors, okay? I'm not taking startup risks, okay?
Yeah.
So I just love my job today. It's fantastic entrepreneur supply that we see. And we get to back and work with entrepreneurs. And today morning, I'm at a high, okay? Sedemac listed very well. So I can talk about that.
So if I may take a lead from what PR has just shared with us, saying that, look, there are companies which chase market share first, and then later on need to, when that phase is over, they need to become profitable, right? In our experience, that is super challenging. Because think about it, when you start with a market share approach, most businesses invariably tend to discount, right? India is a fickle market, right? So whether it's a B2C bit or even a B2B gets even more difficult to change your pricing at a later date. Once you start discounting, the perception of the product proposition becomes a discounted at a certain price kind of proposition. After that, to say that, okay, I'm going to premiumize gradually or change the price of the product, everything else being the same, the customer does not buy it, right? And that is where the challenge comes. That's one. Then there are organization challenges also. When you're used to functioning in a certain way, to suddenly change the organization culture, mindset, to say that, okay, now I'm going to become profitable, it's very challenging. There might have been a couple who managed, but I think the predominant trend that we have seen with a lot of companies who have adopted that strategy is they find it very difficult to get back to profitable growth. So when we look at businesses at the very outset, so I think the rest of the panelists typically invest slightly later than where we come in as Cactus partners. We are post-product market fit. So when we are evaluating a business, we typically come in at Series A. I mean, it's not important for us.
Yeah.
PMF is our gating criteria, but that invariably happens at Series A. Now, at that point in time, when we are evaluating a business, we look at broadly three things. We say, do you have a minimum revenue scale, which means customers are buying from you? Two, we want to see a high retention rate and a low attrition, right? That shows that the customer values the product. But more importantly, at what price are you selling it, right? If you sell something at a discounted price and the product is good, people will keep buying it. But are you getting value? Is it all consumer utility, or are you getting some producer utility out of it as well? So we want to see high gross margins, industry-beating gross margins. Because if you have industry-beating gross margins and you're selling each incremental product sale or a contract, ensures that you have the ability to become EBITDA positive. Right? So even if you are EBITDA neutral when we invest or slightly EBITDA negative, we know that you'll become EBITDA positive within a year's time or 12 months, 15 months time or 18 months time. So that is something that is very critical. So when we look at a business, we prefer not to invest in companies that are chasing market share. If they have clear plans that, no, we are going to do this for the next 3 years and then turn profitable, we try to avoid such situations because we realize, we don't know whether they'll be able to achieve it or not, given the, the trend of challenges we've seen in the industry.
So it's interesting. Let me actually go around the panel and I have a very specific quantitative question. What proportion of deals you've considered in the last 12 to 18 months actually fell off because you didn't think the entrepreneur or the founding team was not ready? It could be mindset, it could be just understanding of the business and being able to manage this growth versus profitability trade-off. Like, I want to understand what proportion of the funnel is just not able to graduate, to growth equity.
I'll take a leap at that, Madhur. I think at least half the businesses that we pass on would be for that reason.
Oh, wow.
And I think that the desire, I think you brought up a very important point. It's not because we're investing in the mid-market. If I say the processes all need to be perfect, we will literally have no pool to invest in. But the desire to institutionalize should be there. And that desire is so important because it allows you to pivot even in terms of strategy.
Wow.
So I'll pull up one example from our fund too, which is a company called Gynoveda. And it does Ayurvedic products, to solve for this fertility issue. When we invested in the company was selling 95% of the revenues were online. And we are mid-market investors, we are not VCs. And we worked with the company over a period of 2.5 years to completely pivot the business offline.
Wow.
And because the desire for institutionalization, so I think the way we look at it, it's very similar to what Rajiv said. I'll add a couple of points. One is the demand should absolutely be there. You should be solving a real problem, not a make-believe problem that you'll figure out along the way. The second is your go-to market should be repeatable. If your go-to market is repeatable, it means that you need to understand that you have to have the processes in place. You may not have it in place. And we certainly have businesses where promoters have focused on growth first. They know they need to get to that. That's okay. But you need to understand the desire for institutionalization has to be very strong.
Anybody else wants to go at that? What proportion of the deals fall off because of the founder, entrepreneur team not being ready?
I would actually say that I want the promoter to be self-aware. It's a very rare quality, okay? They have to be self-aware. They should be able to say, this is what my business is strong at, this is what I am strong at, and these are the places where I need help. And he is out looking to get the people who will help him. Okay? That is like my dream entrepreneur, right? If the entrepreneur is not self-aware and I have to point out things to him, and many times he resists, okay? He say, yaar, this guy, Johnny come lately is giving me advice. Kya janta hai mere business ke baare mein? So I don't give the advice, so I don't try. Okay, but if he is not self-aware, then the deal falls off.
Dushyant, especially on B2B, we've been talking a lot about B2C. Anything around B2B?
No, absolutely. See, at the stage we're investing, unit economics is fundamental because when you're coming in, you're actually buying revenue, but you have to be very clear that you will be exiting EBITDA or PAT, which means that you have to have at our investing stage, we need to be very clear of the underlying unit economics, what will be steady state EBITDA, what will be steady state PAT, because that will drive your exit. So unit economics is absolutely fundamental. I mean, typically where we are investing, we see either positive EBITDA, which will scale up with, as the business scales up with operating leverage, or as Rajiv said, sort of, 6 months to it's more or less at break even and EBITDA will scale up. So that is absolutely fundamental. I think the other couple of things that we look at, so in a lot of industries, and this is across B2B and B2C, you will actually see that a single product or a particular channel or a particular market will only scale to a certain stage. We're very clear that in order to have a meaningful public market exit, you need businesses that get to at least 100 crores PAT. Now, in order to get to that kind of scale, do you need to be in a new market? Do you need to launch a new brand or sub-brand or a new product line? And where will that come from? Does this founder and team have that vision? As PRS said, it's, a lot of these businesses that might have a VC founder are, they're technocrat-led. They often have that team in place. But the next level is really the culture, right? You might have a team that's capable of making good decisions, but do you have the culture of letting the decision be taken by the next line? Because often, launching into a new market or launching a new product or brand will require that kind of expansion to get to the stage that we would exit. So for us, even if the business will get to 600-700 crores revenue, maybe that's not still investable for us because we don't see a viable exit at that point. The other challenge in India is that not too many acquisitions, strategic acquisitions happen beyond a certain size. So in most cases today, the exit has to be at public market or public market scale. That's what you need to underwrite. At that stage, if you have a different exit, it evolves that way.
Yeah, Rajiv, you're trying.
Hi. If I can sort of take a leaf out of Dushyant's book and add to that, I think even Shivani mentioned that the exit environment has improved a lot. But if you see the exit options, what do we have available, right? It's the IPOs. How many M&As happen in the country? Hardly any, right? So for any investor, any company looking to scale and for an investor looking to exit, maybe we had the heydays of 2021 when people were just following, blitz scaling with no regard for profitability, but those days are gone, right? We started investing in 2021 and the investments we made in that year actually moved up 2x, where much of that vintage is struggling with even catching up with the valuations they had paid at that point in time, right? Now, early stage has to go through transition. So they'll go to early stage to early growth to growth, right? An early growth investor will look at unit economics because they will say that, look, I want you to become EBITDA positive during my investment period to make sure that I can sell you to the next investors coming in. M&A, few and far between. So what are the options available to us? It's largely trade sales to folks like my fellow panelists. So if you do not have profitability in your business, exit is going to be super difficult and you're going to be stuck, right? Which is why it is essential that businesses now look at profitability at the very outset, rather than say, let us chase wallet share and market share and all, and then after that we'll come back.
So that's actually very interesting, and I'll come to Siddharth here. See, one of the things we see as we diligence some of the growth assets is that sometimes the business is still catching up with the valuation, right? And unfortunately, the early stage business has been already valued at a level, maybe through 1 or 2 rounds of venture capital or even early growth in some cases. And the only way to justify the valuation is to do things they've never done before. Online has to become offline. Shivani already mentioned that. D2C has to certainly go into general trade, right? A new product adjacency needs to be explored to be able to derive the full CLTV from the customer, right? So, Siddharth, the question to you is, how do you see that, and what can an entrepreneur do to actually avoid getting into this valuation trap where you are having to underwrite a lot, building of a lot of new muscles, and then it feels venture-ish or expensive or both?
That's a great point. I think it's a struggle that we faced in terms of underwriting VC-backed companies. And, most of the time we just don't get there. We don't get the comfort that we can even meet those valuations that were done in previous rounds. Because obviously the business hasn't met the expectations that were set out when they raised that round. So, frankly, we stay away from those because, pricing discipline is very important. And, we've also seen when you have a business plan that includes a lot of sort of blue sky numbers in terms of new avenues of growth, new products, new channels, you have to obviously take that with a certain risk level and discount some of that. And it's not easy to obviously open new channels. So for example, if you look at consumer companies, historically we've seen in terms of their evolution from, let's say, D2C to offline, that's not been a straightforward evolution. The DNA and the skill set is very different. You can't have the same team that, runs the D2C channel running the offline channel because it involves, different skill set like distribution muscle and credit cycles and relationship with retailers, etc. So that's one example of moving from an online to offline channel, which is harder. We've seen companies in spaces like financial services, which are very entrenched in a particular state, for example, and we can underwrite that in terms of going deep into that state because they have the local brand and the connections in the team. But once you go beyond that state and try to become a pan-India player, it's not so easy again. So again, you have to kind of temper your projections when you're trying to, become a pan-India player because, that same brand awareness is not there. And then also what we've seen is hiring talent in new states or new geographic areas is again not easy because your brand again, is not as strong there and there are strong local incumbents already. So getting the right team as you expand into new areas is also very critical and not so easy, especially for mid-market companies that potentially don't have large budgets for hiring. So overall, I think hard to underwrite very unreasonable projections like that. And the only way to mitigate that is to obviously not overpay. And frankly, we've struggled with matching VC valuations in many of our transactions. So I think the message to founders is probably to also look at the valuations you expect when you raise capital early with VC guys, because you're also then on a very fast treadmill trying to meet those expectations and trying to kind of, keep those valuations increasing all the time. So that's very hard to do.
Rajiv, I'll come back to you. And what is the B2B manifestation of this? In B2B businesses, the issue is promoter-driven sales, taking you to a certain scale. But then you need to professionalize. You need to build a team that needs to go across geographies, vertical service lines, whatever it is. Have you any success or failure markers you've seen on the B2B businesses where promoters have scaled to expand the sales organization beyond themselves?
Yes. So in our portfolio itself, you'll see a number of them where there have been successes, but we've also had our challenges in certain cases. And I think the underlying theme there tends to be, founders not willing to let go in terms of how a business is managed or run. They want to be involved in every aspect or every element of what is happening, right? So there, I think it's something that they have to build a culture of performance. They have to communicate actively with the team, create a second rung of management they trust, who they know are driven, incentivize them. It's important to incentivize them also, right? So if you want to help build a business, you have to ensure that the people want to work with you for an extended period of time and deliver value, right? So you have to put all those elements in place for you to be able to continue to scale. We've seen that, occasionally people tend to sort of want to be involved in everything, and that is sort of, that holds things back rather than enables you to give free rein to your, your colleagues and your second rung of management to be able to build things out. And that's where the systems, processes, policies, delegation of power, delegation of authority within certain, prescribed limits gives people the freedom to go and take decisions. Like if you say, yes, okay, we have to sell a certain B2B product, you have to sit with the teams and think things through about what is the price range within which you have the ability to close a deal, where your gross margins are not impacted, right? So you can't have a salesperson go out and sell something just to close a deal because a customer is saying, I will pay you only this price. You have to be able to, convey the value proposition so that the customer appreciates it. And if they still don't appreciate it, you should be able to walk away if you're not getting your margin, right? The walk away margin that you require for closing a transaction. So you've got to put these systems in place without which, you can't scale. So we've seen that happen in a couple of cases, in which case what happens is that my partner Anurag, he's a highly successful entrepreneur. So he spends a lot of time coaching, mentoring, guiding, working on strategy with all our portfolio company founders and the co-founders to help them think through how they can continue to scale their businesses, putting such systems in place.
Yeah, well, PRS, I'll come to you. I think, post-COVID, we developed a lot of love for mythical characters like unicorns, right? And unicorn, almost felt like achieving salvation and you are a market leader and nobody can beat you, you're invincible. Things have changed. Last 2 years, I don't hear the word unicorn too much. So what does market winner, I will not even use the word market leader, but what does a market winner mean to you? And how do you identify, who is a potential market leader? Because that's what really you are backing when you're investing in growth.
See, it depends on the size of the market. If you're operating in a 1 lakh crore market, unlikely that one of my companies is going to become a market leader in the traditional sense. Okay, but we, for example, in a lot of D2C, we have made investments. We chase what we call our leading challenger brands. Okay, there are very well established traditional brands, and then there are challenger brands that are doing something innovative. It could be in the way that they operate the channel. They might have come through e-commerce or quick commerce or some other way they are coming through, or they are innovating on how the product is very different from what the established brand is. Okay, so when we see that kind of innovation in the way the management is executed so far, I'm not a startup investor, I'm a scale-up investor. So management has done something right, and it is working, and we see that innovative element that they are executing. Yeah. Okay, so that is how we spot the winners. Okay, and then we try to figure out whether what help the company requires to go to the next level. Okay, Sometimes, investors also have to be self-aware. The best thing I might have to do is just get out of the way. Okay, and I shouldn't be trying to add value when nothing is required. Okay, but if the entrepreneur wants certain things, we have discussed about them before we did the deal. Then we get involved in those areas, and we take the company to that next level. So identifying challenger brands which can shake the market up. Okay, and leadership is in form of innovation. Leadership is not in terms of revenues or market share. That's the kind of companies we like to back.
Shivani, would you add to this a little bit?
Madhur, sure. I think, when this whole unicorn hype was going on, we used to internally say we don't want a single unicorn in our portfolio. We want only stallions. We don't believe in unicorns. They're mythical creatures. We like numbers. We like understanding businesses with good fundamentals, strong profitability, good unit economics. That's been belabored a lot by my panelists. So I'm not going to go down that path. But I think what I also want to leave the audience with is there is no one size fits all. So, I mean, we are very fortunate to have several market leaders in our two funds, but there's no one formula. I wish there was, right? So you have companies where we've had to kind of help them institutionalize kicking and screaming. They've also built wonderful market leading companies. We've had others. The example that I gave you was particularly interesting because it was a company that had a very challenging task of moving its business entirely online to offline in a matter of 3.5 years. They went from 50 employees to 500 employees. They dramatically improved their economics, and that could not have happened if there wasn't a desire to institutionalize. Because otherwise, if you don't institutionalize, you can't repeat your strategy. So that's what it is, right? But there is no one size fits all. Overall, I think since I'm towards the end of the panel, so a lot of my panelists have talked about the fact that we look at scale up, we look at unit economics in terms of market leadership. We like looking at businesses where even at a smaller scale, they are showing that they are getting there in terms of market leadership. For example, we've done a deal with Cactus, so I'll use that as an example here, and we have the Cactus team here. And what we really liked about the company when we came in, they were extremely clear that they had a very vertical focus on e-commerce and retail, and they were extremely clear that they wanted to work with us on the BFSI side. So the clarity of thought, the self-awareness, the desire to build in a different vertical was all the reasons that we sort of came in and invested. And I'll just add one more thing, is that we also like-minded earlier round investors. People who are saying the same thing around the table becomes much easier to add and drive value in a company. If there are dissonant voices, you can be, rest assured the promoter will take the voice that is sounding most pleasing.
Correct. No, I think as we are getting to the end of the panel, I would actually want to sort of go right from Dushyant to Siddharth and turn the question a bit less about entrepreneurs, more about growth equity as a business, right? So as a growth equity fund manager, what is that X factor or a differentiating factor that will separate the growth equity winners from others? Like, what is that one thing you would advise fellow fund managers that one should do or not do to basically deliver an outsized IRR or alpha for your investors?
Sure. Okay, let me go first. I think two things primarily. One is discipline, is investing discipline. Very, clarity in terms of what you're going to invest in and why, and at what price you're going to invest and how you're going to exit. The second is the ability to add value to the companies that you invest in. Ultimately, almost everything in investing in India is growth. Whether you're doing minority, which is what all of us are doing, or buyout, which some of the guys who spoke yesterday are doing. But, the fundamental thesis is that the business will grow. And again, like the buyout guys, we also need to be able to add value to the companies that we invest in. Sure, the founder continues to run it. we don't own the same level of stake that they do, but can we help them scale up? Can we help them debottleneck? Can we help them get to a meaningful size, scale, governance, and outcome in terms of an exit?
PRS?
I think the thing that you need to focus on in how you're building your team is to get the team to be focused on exit outcomes. Okay, I think people love doing deals. Okay, मगर deal करना आसान है. Okay, कोई भी deal कर सकता है. Exit करने में challenge है. Okay, only the guys, you are separating the men from the boys only when the exit happens. So getting the team culture to be focused on that. Okay, and the incentive system inside the organization has to be focused on celebrating exits much more than celebrating investments. You get that right, then you get a team that is batting for DPI. Okay, I mean, we do have a good history of DPI in the last 4 or 5 years, and we need to do much more. And my own view is that, it's not like I want my fund to do well. I think the industry has to do well as well. I don't want to be going around selling India every time I go fundraise. India should already be pre-sold, and that will happen only when the industry does well.
Rajiv, yeah, a short
one. So they've covered much of it. If I were to look at businesses which are in the growth phase and founders, what we typically look for are founders who have, who are humble but confident, who are self-assured but are execution-oriented, who are building the brand of the organization and not their personal profile on social media. Yeah. So let me just add to that, because that mindset actually translates into all the things that we are working with the founders, a team of founders to deliver. So that's it.
Shivani, anything around growth equity funds?
Since you asked the question about what the advice for growth equity investors,
yes.
Know how you're going to, rule number 1, know how you're going to exit. Rule number 2, don't forget rule number 1.
Sid, you have a raw end of the stick, sorry for that, but...
Yeah, I think everyone's covered the main points, but look, if I were to be honest, I think luck and timing are crucial in delivering outsized returns, despite what everyone thinks. But look, I think there are 2 points in terms of what's critical for growth capital deals. One is getting the counterparty right. That's the biggest risk, but also the biggest reward. If you can back a founder that is looking to build an everlasting institution, I think you're most of the way there. And the second thing is discipline or entry valuation. That just gives you the cushion you need if things don't go as per plan, and it never does in India. So having that cushion is also very important.
Excellent. Thank you, everyone. We are we're definitely beyond time. Thanks to all the panelists for a very lively conversation, for your time and for the rich insights. I really appreciate all of it. Thank you to the very patient audience for supporting us in getting this panel through. But yeah, we learned a lot about what kind of entrepreneurs to back, what kind of entrepreneurs to not back, and we all wish Indian growth equity as an asset class to really boom and uncover the $70 billion potential that we spoke about in the report. Thank you, everyone.
Thank you.
Thank you. Thank you so much.